Good afternoon from Prague. My name is Romana Krizova, and I'm going to tell you a little bit about commodity spread trading and commodity trading based on seasonality. Futures trading as well as exchange trading in general is of course risky because we are making all the analysis based on historical trades and historical data. So first of all, I would like to introduce myself. My name is Romana Krizova and I live in Prague. I'm the owner of the company TradeandFinance.eu and I'm the active trader. I focus on trading commodity spreads and I started with active trading in year 2009-2010. And very soon I became really focused on commodity spread trading. I tried different types of approaches, including the intraday trading, but I find the intraday trading very stressful and my psychology is not good for the intraday trading. And I also tried forex trading, which I find very risky. I also tried options, which worked very well for me, but most of all, I really prefer commodity spreads because I consider them the least risky, and also the fact that there is the phenomenon of seasonality is a very strong aspect of this kind of trading, and it increases the level of probability that the trades could act a similar way as they acted or performed in previous years. I increase my trading capital in tens of % per year. And I'm also training people about how to trade commodity spreads. And as I will tell you at the end of this webinar, I also provide bi-weekly analysis of commodity spread markets, where we always identify certain trading opportunities and we analyze these markets to see whether there could really be the potential for trading, or if it's the situation when the statistics tells us that the performance was wonderful in the past, but in the current year, the spread doesn't seem to be performing the same way. So all this is what we analyze during these webinars, which we organize every second week. I also have a qualification of the investment broker. So this is about the company TradeandFinance.eu, and in our company, as I mentioned, we provide courses of exchange trading, but we also try to inform the general public about the opportunities of exchange trading and especially the commodity trading. And we also try to clarify different types of myths of trading. At the same time, we are trying to pass our personal know-how and experience, and we are passing this know-how in a form of articles and videos as well as courses. Let me quickly introduce the website and the portal of our company, just to let you know what you can find here. When you click on the logo, you will always get to the initial slide within the slider. And here you can find the most relevant and most up-to-date information, something what we would like to tell to our users and visitors. And you can see different types of slides with information which is the most relevant. However, apart from the slides, you can also find information about the courses, either via this link or via this menu at the top of the portal. And also, if you are interested specifically in courses, then in this part of the homepage, you can find all the information about them. In this part, you can find information about the online courses, which are pre-recorded videos, and you can always get back to them. Then we have webinars and group courses, And now at the end of August and the beginning of September, we are going to have a new set of webinars on commodity spread trading. And here in November, you can see that there is going to be this live seminar with me in Prague. It's going to be a 3-day course. And we also organize webinars, like today we have the free webinar, and also in a form of webinars we organize bi-weekly analysis of current commodity spread strategies. So this is especially useful for the participants of our courses, because when they took part in the 2-day course, they can practice, they can exercise, they can also send their own spreads, and we analyze them all within these bi-weekly webinars, which usually take 1 hour or 1.5 hours, depending on how many questions there are and how many spread opportunities there are. And you can also find different types of articles on our portal. You can get to them either through this icon and this link, or again via articles in this menu. And if we clicked there, then there are different types of categories. And we can click on commodity spreads, for instance, and there is a series of articles that may be useful for you if you are interested in this particular area. And for the people who don't like to read, but they prefer to watch, we also have a set of videos, and you can again click on the link on the menu, and then we have again the categories, and you can quickly get to the right set of videos. So right now we have a new short video about how to profit from seasonality. It's an 8 minutes long video which explains the principles of commodity trading and commodity spread trading. So this was the introduction about the company that I represent, and we can start with seasonal trading of futures and commodity spreads. First of all, I would like to tell you a little bit about seasonality. Seasonality is something what is very important, and it's a key characteristic or a key feature of most of the commodities. And this is something what gives us the edge. And in comparison, for instance, to stock exchange trading or forex trading or index trading, where you cannot find any kind of seasonality, in case of commodities, seasonality is a very, very strong feature. And seasonality means that every year at more or less the same time, there is the price increase or decline in case of a certain commodity. And this we can explain on example of heating oil, for instance. The heating oil, we need it for heating, obviously. So usually it gets more expensive in winter and it gets cheaper in summer. Similarly, gold. Gold gets usually more expensive in autumn because we usually want to buy jewelry as Christmas gifts, and therefore the jewelry industry needs gold for producing all this jewelry which is sold at Christmas time. And then after the new year, usually the price of gold decreases. And this kind of seasonality is something what we can see in case of most of commodities. And because we can expect this kind of price increase or decline every year at more or less the same time, then it gives us a higher predictability of trades. So if we started to buy gold at a particular time of the year in autumn, then we are more likely to make profit than if we decided to buy gold in January after the new year, because then the price would be declining. So this is the principle of seasonality, and it's very, very important because we can very nicely use it for commodity trading. And here is a link to a short video. This is the new video that I mentioned. And you can also find the link to this video on the slider of our portal. And there we also explain the seasonality in a short time. So how can we profit from seasonality? I already mentioned that seasonality basically equals to predictability. This is a very important feature of commodities. And the seasonality gets even multiplied in some cases when we trade two commodities at the same time and when we expect strong seasonal movements in case of each of these commodities. So let's have a look at a very simple scheme where we will explain this principle. Let's say that we have the corn and we have the wheat. In case that we bought corn because we expected seasonal increase of the market price, and at the same time, we would expect the price decline of wheat, so we would sell wheat. At the beginning, at the start of this trade, there would be this kind of price difference between these two commodities. And because we bought corn and we sold wheat, and we are expecting that the price of corn is going to increase and price of wheat is going to go down, then we know that there is going to be the bigger price difference between these two contracts. And in case that this price difference kept increasing as we expected, then we can make profit on this increase of the price difference. So this is the original price difference, which was at the beginning of our trade. And everything what is bigger is our profit at the end of this trade. And this is what we call commodity spread trading, because the price difference between the two contracts is something what we call spread. When we buy one commodity and we sell the other commodity, then there is a price difference between them, which we call the spread, the commodity spread. And commodity spread trading is based on speculating on the fact that the spread, the price difference between the two contracts, is going to increase. And then we are speculating on having this kind of profit. The commodity spread trading is also interesting because this kind of trades is less exposed to fundamentals. So in case that we bought corn and we sold wheat and suddenly a flood would come, the flood would actually affect both the corn and the wheat. And the result of the flood would be that there would be a lack of grains, and obviously it would increase the value of the grains because there wouldn't be enough of them on the market. So the fact that there is a lack of grains as a result of the flood, it means that it's going to affect both of our commodities that we are trading. So what's going to happen in case of commodity spread trading? If we bought corn and we sold wheat, initially our trade would develop in this way as we expected. The spread between them would keep increasing. We can see it here. But then suddenly the flood would come. So what would happen? We know that the price of both commodities would be very likely to go up because suddenly there would be lack of these commodities on the market. So the price of wheat would start rising. This is what we don't really want because we were speculating on price decline. However, the price of corn is going to rise as well. So in this way, you can see that actually our trade, where we speculated on increase of the price difference of the spread between the two commodities, and this actually happened because the flood affected both of the commodities, and as a result, the spread stopped increasing, but it didn't decrease. And therefore, if we only traded wheat, we would experience a loss. But because we traded the spread, then our trade was less exposed to the fundamental. In our case, the fundamental was represented by the flood, and our trade would result in a profit. The profit may be lower than we expected, but it's still a profit, which is the key principle of our trading. So this is what it means when we say that when trading commodity spreads, these trades are less exposed to fundamentals. Of course, it doesn't always work in this way. It's always risky, but we can say that there is a lower exposure to fundamentals, but you are never 100% protected, of course, but simply it's safer than a traditional trading when we trade so-called naked positions. Only trading wheat would be a naked position, which would be exposed to the flood. But in case of trading two commodities at the same time, this is what we call covered positions. And it's trading based on hedging principles. So our trade is hedged against the risk, but there is never 100% protection. This is very important to keep in mind. Let's now get to the spread trading. So the spread is not only something what is used in relation to commodity spread trading, to something what I have just demonstrated, but the term spread is also used in other contexts. Normally, spread always means a price difference between the two price values. It can actually be more than two price values, but today, in order not to make it too complicated, we are only going to speak about price difference between two commodities or two underlyings. So spread is always a difference in price between two price values. The most often you will see this term as a spread between bid and ask. So whenever you are buying or selling an underlying, which may also be stocks or forex, there is always a bid price and ask price, and the difference between them is also called spread. You could also come across a spread in options trading, but spreads in options trading are traded in a totally different way than in case of commodity spread trading. And today we are going to focus on commodity spreads. If you wanted to know a little bit more about the use of the term spread in exchange trading, then you are welcome to read this article on our portal. As I already demonstrated at the beginning on the schemes that I showed, spread trading is in fact speculation on increase of price difference between a long and short positions of futures contracts. In other words, we were buying the corn, that was a long position, and we were selling wheat, which was a short position, and we were speculating on increase of the price difference, in other words, spread between these two commodities. And it's important to mention that both the long position and the short position, both of them are open at the same time. This is very important. And the commodity spreads, they work on seasonality basis because we are mostly working with commodities. So we can use this factor of increased predictability of trending markets. And as a result of that, there is a higher level of winning probability when we speculate on increase or decline of the price difference between the two commodities. And all of this can be checked and watched on so-called spread charts. Before getting to spread charts, I will repeat once more what I already mentioned, and that is the difference between the outright and the spread position. The outright position is something what we call the naked position, and this is the situation when we speculate on price change of a particular commodity. That would be the case of wheat that I showed. We were selling wheat, so we speculated on price decline of the wheat. And then the flood came and the price of wheat started rising. So that was a typical outright position. That would be naked position, which is exposed to fundamentals. On the other hand, we can trade spread positions, which are so-called covered positions. And that means that we are speculating on the price change between the value of two trading positions. So once more, we bought corn and at the same time we sold wheat, and we speculated on price increase of the values of these two trading positions. We are covering the exposure of these positions. It's trading based on hedging principles. So it's important to bear in mind that the spread is always a combination of two positions, of the long position and the short position. And in this case, we call them legs. So a spread is composed of a long leg and a short leg. So let's explain the principle of how the spread chart is actually displayed and how it's constructed. On this slide, we can see two charts in the upper part. And this is the chart of the long leg. So this is the market where we were opening the long position. It means that we were buying the underlying. In this case, it's wheat traded on Chicago Commodity Exchange on CBOT. So we were buying the Chicago wheat, and at the same time, we were selling the Kansas Commodity Exchange wheat. So we bought Chicago wheat, and at the same time, we sold the Kansas wheat. So these are the two legs. This is the long leg and the short leg of our spread. The two vertical lines that you can see on each of the charts, this is so-called trading window. It means that we entered the position on this date, which is the 14th of January 2013. So we bought the Chicago wheat on this date, and at the same time, at the same moment, we sold the Kansas wheat. So it's again the 14th of January, exactly at the same moment. And then we closed both positions at this date. This is the end of the trading window, which was the 4th of April 2013. And we can see that in case of the Chicago wheat, the price was declining. And in case of the Kansas wheat, the price was declining as well, but it was declining much faster than in this case. So, how to calculate the spread? The spread is always the value of the long position, which is this, minus the value of the short position, which is this. So it's the value of the Chicago wheat. It's this value, 784.75 minus 851.25, which is the value of the short position. And we get the value of the spread. It's minus 66.5. And this is what we can see here on the spread chart. So you may get puzzled by the fact that you see a negative value. It's absolutely normal in case of spread trading. So it's important that we are displaying the chart of the price difference between the long position and the short position. And at the end of the trading window, the value of the spread was this price minus this price. So you can see the calculation in here again. So the value of the spread was minus 32.5, which is here. So the price difference between the Chicago wheat and the Kansas wheat increased, and this is what we want. So you can see that in spite of the fact that if we traded the Chicago wheat on its own as a naked position, we would end up in a loss. But because we traded it as a part of the spread, we had a profit, and the profit is $1,700, and it was made within this period of time. And this is the profit that we made on one contract. So we bought one contract of Chicago wheat and we sold one contract of Kansas wheat, which is one contract of the spread position, of so-called combo position. So this is the value of the increase of the spread, $1,700 per one contract. So here we explained the principle of constructing the spread. And here we have a scheme of when we can be in a profit when trading spreads. So the most logical and most typical situation would be what I demonstrated in the example of corn and wheat. Let's say that we bought commodity A, let's say corn, and the price increased. And at the same time, we sold wheat and the price declined. Then obviously the price difference between them increased and there would be our profit. And the profit would be the difference between this and the increased price. So let's say it would be something like this. This would be the value of our profit. But we can also be in a profit in case that the long position was going down, the price declined. And in case of the short leg, the price was declining as well, but it was declining much more and much faster than in case of the long leg. So you can see on this scheme that the price difference increased and our trade resulted in a profit as well. So even if one of the legs was actually losing, then the spread as such resulted in a profit. So this is very important to remember. But of course, we could be in a situation that this commodity A, the price of that would decline much faster than the short leg, and then our spread trade would result in a loss. So I wouldn't like you to get a false idea about spread trading to result in profit every time. So it's not the case. The spread trading can also very often end up in a loss, but we are working with higher predictability thanks to seasonality. This is one of the key advantages when trading commodity spreads. Let's now have a look at the spread chart, how it looks like. You can see the print screen from the SeasonAlgo platform. And this is how it looks like. And the black curve here, this is the current year spread. This is the spread of the heating oil. So this is the long leg and this is the short leg. And here, these two lines, this is the beginning of the trading window and the end of the trading window. And we know the dates because we made the search in the SeasonAlgo platform, and the SeasonAlgo evaluated this spread as the one with the highest potential and with the highest possibility of ending up in a profit. We can also see these colored curves, and these are so-called historical patterns. The red one is 5 years historical pattern, and that means that the SeasonAlgo took prices of previous 5 years and it calculated the average of these prices, and this average is displayed here as 5 years historical pattern. Then the green curve is the 10 years historical pattern. The blue one is 15 years historical pattern. And this orange one is the 20 years historical pattern. And we are looking for such spreads where the correlation between these historical patterns is as high as possible. And we can see just by looking at the chart that in this case the correlation is really high. And in case that the current year spread correlates with these historical patterns before the beginning of the trading window, then there is a high probability that the seasonal movement is going to happen also in the current year spread. And this is what we want. Later, I'm going to show you in the environment of the SeasonAlgo what kind of analysis we can make and how we can decide whether the spread is worth trading or not. I'm going to tell you a little bit about the markets that are suitable for commodity spread trading. The most common are grains. And in case of grains, these are the most suitable for beginner spread traders because there is the lowest volatility and there is a very high liquidity. This is something what we want. We need to have enough traders. And also in case of these kind of markets, we can trade them with the lowest risk per trade comparing to the other markets like meal or energy. So for instance, even with a lower trading account, we can open the trading position with more contracts, and entering the trading position with more than one contract means that we can apply more advanced risk management, and that obviously improves our trading results. Then we can close different contracts at different profit targets, and it very much improves the trading results, and our portfolio, our equity can increase much faster than in case that we only trade it with one contract. And also what is very interesting with grains is that we can trade so-called intra-crop spreads. Legs of the spread are composed of the expiration months which fall within the same crop. That means, for instance, that we would trade corn with expiration in July and the other leg would expire in September. These expiration months would fall within the same crop. And that also means that in case that there was a fundamental such as flood in summer, then the fundamental would affect both of these legs in a very similar way. So then they are less exposed to the fundamentals. Whilst if we traded the spread, which is composed of legs where the expiration months are far apart, then the exposure to fundamentals increases significantly. So they are more risky. So the intra-crop spreads are very suitable for beginner commodity spread traders. And also it's wise to trade the spreads which are composed of the same commodity but different expiration months. So we can buy corn with expiration in July and sell corn with expiration in September. And this is something what we call the calendar spread. It means that we have the same underlying, the same commodity, but different expiration months. In case that we had the spread composed of two commodities, like what I demonstrated on the scheme where we bought corn and sold wheat, this is what we call intercommodity spread. So the spread composed of two commodities, and they are more risky because they are more volatile. And you need to have a bigger trading account for opening the trading positions with more contracts. But this is what we clearly explain in detail in our full courses. Here we can just tackle all this in a very shallow way. But in our full courses, we explain very, very clearly what it means and what kind of spreads are less risky and more suitable for beginner traders. Then a popular category for spread trading is meal, like live cattle, lean hogs, feeder cattle. And again, we can trade them as calendar spreads or intercommodity spreads. Meal is a bit more volatile than grains, so it already requires to have a little bit of experience. And this is also relevant for energy. Energy in general is quite expensive. So for trading spreads composed of energy, again, you need a bit bigger capital and you need to have a bit of experience before making live trades of energy. However, even there, we have markets like heating oil, which are cheaper than the other energy markets. So the heating oil is also suitable for beginner traders. And even with smaller trading accounts, you can enter the trading positions with more contracts. Then we can also trade currency as spreads. In fact, we should be saying futures spreads because, as you can see here, we can trade currencies or financials, which are not commodities, obviously. But usually traders use the term commodity spreads. So therefore, we are not saying futures spreads, but we are using the term commodity spreads. But we can trade currencies as commodity spreads, but they are quite risky because in general, trading Forex and trading currencies is quite risky and you really need to know what you are doing when trading currencies, and they are very, very exposed to fundamentals. So I definitely wouldn't suggest this to beginner traders. Then we have some financials or metals. Metals, they are very interesting. However, these are expensive markets. So again, if you wanted to trade them, then you need quite big accounts, quite big trading accounts. So it's necessary to be careful about them. And this is something for a bit later when you are experienced and you know what you are doing. And then there is a category of softs or food. And there are these types of markets and they are very volatile. And I wouldn't suggest them for beginner traders. Even experienced traders are very, very careful with this kind of markets. Let's now continue and we will speak about the advantages of commodity spread trading. We already spoke about the seasonality and we are going to get back to it and we will speak about seasonality in more detail. But before that, we will also mention a lower volatility, which implies lower stop loss and lower risk per contract. And also we will speak about lower margins. Also, it's important to mention that commodity spread trading is not time consuming. There are very low time requirements. Of course, you have to learn this method of trading, so that will require some learning time. But after you have mastered this method, then you will usually need about 2 to 3 hours per week just to prepare some interesting spreads and to check the trading positions or the possibilities of entering the trading position. Usually I prepare interesting spread trades twice a month. Usually every second Sunday I just sit down and for about 1 hour I check interesting trading opportunities and I save these spreads in a portfolio in the SeasonAlgo. This is what I'm going to show you a bit later on. And then I usually check these opportunities every day, but just for a few minutes every day. It doesn't mean that I'm sitting in front of the computer the whole day long, checking and waiting for a signal or something like that, like what you know from intraday trading. The commodity spread trading is done with a daily time frame. That means that we usually stay in a trading position something between 2 to 8 weeks, and we check the position either once a day or with a mobile phone. You can just switch quickly to the SeasonAlgo just to check your spread charts to see if everything is fine, or if you need to find a computer to make some modification. But in principle, it really doesn't need more than about 2 to 3 hours a week. Let's speak about the volatility and also about the low margins. So the volatility is about how much is the price of a commodity or of the spread moving within one trading day. Let's demonstrate it on the example. This is the volatility of an outright position. The outright position is when we trade so-called naked position. It means that we speculate on the price increase or decline of a particular commodity. On this chart, this is the example of corn. And if we were trading corn, just corn, not combined with anything else, then here we can see what was the price move within one particular trading day. It was the 7th of February 2012, and here is the opening price and the closing price. And during that day, the difference between the opening and closing values is $625. Of course, we don't have the high and low values because this is the line chart, and the line chart is what we typically use when trading spreads, and we use the daily time frame. So every move, like this is one day, this is one day, this is also one day. So the price move within one day was $625. Let's have a look at the daily price move in case of the spread. We can see it in here. This is the spread, which is constructed of a long leg of corn with expiration in September 2013, and the short leg, which is again corn, with expiration in July 2013. So this is so-called calendar spread, where we have the same commodity but different expiration months. And here the daily price move, it means the volatility, was only $100. And this is what happened the same day, the 7th of February 2012. However, I would like to underline once more that the lowest volatility is in case of the calendar spreads like this one. In case that we started to combine commodities, the volatility, in other words, the daily price move, would start increasing. So in case that we had corn combined with wheat, for instance, or with soybeans, then the volatility would be higher. So this is very important to mention. And in this case, we could enter the trading position with more contracts. Normally, when trading spreads, we should risk maximum 5% of our trading account per trading position. It means that in case that we had $10,000 trading account, then 5% risk would be $500 per position. So if we traded the outright, we wouldn't even be able to open a trading position with a single contract. In case of the spread, we could open the trading position with 5 contracts, and that already enables us to apply advanced risk management and to work with different contracts and to close the different contracts at different profit targets. So this is the volatility. Now let's have a look at the margin. The margin is something what is typically used when trading futures. And when we trade futures, if we wanted to buy one contract of corn, like here, then the broker would block $1,000 on our account. Let's say we had $10,000 in the trading account, and we wanted to buy one contract of corn. That means that the broker would block $1,000 on our account, and they would still belong to us. It's not the money that we would lose or that we would have to give to someone. This is our money, but we cannot dispose with them during the time when we have the corn position open. So our disposable capital would be only $9,000. Then we would either make profit or we would lose the money, and whichever, we would close the position after some time. And after closing the position, the broker would release the margin. They would release this amount of money which was blocked during the time when we were in a trading position. So the margin in case of outrights is $1,000, or lately it was $1,000 per contract of corn. Imagine that you wanted to buy more contracts of corn. So then it would be multiplied by the number of contracts. In case of a spread, here we have the example of the calendar spread of corn. Because we are buying one contract of corn and selling another contract of corn with different expiration months, we would expect that the margin would be $2,000 logically. But in case of spreads, the exchange usually makes the advantage of trading them, and the margin would only be $50. So imagine, it's not $2,000, but it's $50. Again, the margin is lower, especially in case that we are trading the most common categories of futures, like for instance grains, and especially when we trade calendar spreads. It means like this example of corn, where we have the same commodity with different expiration months. So then the margin can be as low as this, which is really remarkable. So now we are coming back to seasonality that we already mentioned. So the spread trading is absolutely based on seasonality. The seasonality is the key factor when trading commodity spreads and when selecting the trades where we expect a high seasonal tendency. And this enables us to search for potentially winning trades, because we have this advantage of statistics, because we have digital data. And when we have data, we can evaluate the data and we can statistically work with them. And thanks to all this, we can find the trading windows where the seasonality was the strongest. And this is where we use the SeasonAlgo platform that I'm going to introduce in a little while. And we are searching for trading opportunities by correlation of the current year spread with seasonal tendency and historical patterns of 5, 10, 15, and even 20 years. This is what I showed you already on the spread chart, and I'm going to show it to you again several times today. So the markets which most correlate with these long-term historical patterns, they have the highest winning potential. It means that there is a highest possibility that such a trade could result in a profit even this year. There is never a guarantee, but there is a high probability. And usually we try to enter spread positions on seasonal highs and lows, but thanks to the SeasonAlgo platform, we can enter the positions not only in these breaking moments in trends, we can also enter the trades within trending markets, but I'm going to demonstrate it in a little while. So, and the tool which enables us the searching and analyzing of these trading opportunities, this is the SeasonAlgo platform. So here you can see another chart that was found by the SeasonAlgo platform. Here we can see again the trading window. This is the beginning of the trading window and the end of the trading window. That means that the SeasonAlgo analyzed trades which are available in the database. And this trade was one of the most profitable and most winning trade in the past. So there is a high possibility and high predictability that even this year it could result in a profit, because there is a very strong correlation between the historical patterns within the trading window, and there is also a high correlation outside of the trading window. And there is also a very good correlation with the current year spread, which is the black curve, with the historical patterns. So again, this is what we are looking for. And the SeasonAlgo tells us exactly when we should enter the trading position. This is, in this case, it was the 13th of March 2014. And we should exit the trading position the 31st of May 2014. So just to summarize the advantages of commodity spread trading, it's trading which is based on hedging principles, because we are covering one position with the other one. There is a lower impact of fundamentals, but it never neutralizes the impact of fundamentals. The impact of fundamentals will always be there, but it can get lower in case that we traded commodity spreads, and especially certain types of commodity spreads. Also, what is very good is that there is a strict regulation, because we are trading commodity spreads as futures spreads. And when trading futures, these trades get cleared via clearing centers, which are a part of commodity exchanges. Another advantage is the seasonality that we mentioned many times today. There is a high liquidity, because commodities are one of the most liquid markets, and liquidity means that there are many traders, and that also means that when there is a high liquidity, then there is a low difference between bid and ask prices. There are low margins. There is lower volatility than outrights. This is what we explained. That implies lower risk per trading position. And commodity spread trading is suitable for beginner traders. By beginner traders, I mean the traders who already know what is the volatility, what is the volume, how the exchange works, what is the nature of trading futures, what is the technical analysis, what is the fundamental analysis, what kind of trading orders we have, and in what situations we should use them. But by beginner traders, I mean those traders who didn't yet choose the method of trading that they would like to apply. So for starting with commodity spread trading, you don't really need any previous experience. You can start from scratch, but if you don't know the basics of exchange trading, then I would recommend you to take our course of exchange trading for beginners. But we will get to that later at the end of today's webinar. And what is important is that thanks to seasonality and thanks to the data that we have for many decades, we can work with the statistics and we can identify the spreads which had the highest winning percentage in the past. And that gives us a better predictability and better or higher potential of winning. So this is very, very important, because this is a great advantage of trading spreads. And the increase of the trading capital in case of spreads can be something between 20 to 80%, but it very much depends on experience of the trader and also on how much he applies the risk management. Again, the risk management is the key issue in exchange trading, not only in case of commodity spread trading, but in exchange trading in general. And what you need for commodity spread trading, you need a trading account at a broker which enables trading so-called combo spread positions on lower margin. And that is, for instance, the interactive brokers. And Interactive Brokers is established broker. They exist since 1977. So they have a long history. And for commodity spread trading, you need a trading account of at least $10,000. This is also the basic capital that you need for opening the account with the Interactive Brokers. And even if Interactive Brokers required a lower capital, I would strongly recommend to start with at least 10,000 US dollars, because otherwise, if you entered a few trading positions and all of them either resulted in a loss or suddenly there started to be a correction in all the markets, then you could experience the margin call, or you could even lose your trading capital. So it's really important to have sufficient trading account to start with trading commodity spreads. However, if you opened the trading account with Interactive Brokers, then of course you would get a simulated account and you would get a live data, and you can use it for learning how to trade spreads. So I would definitely recommend to work with a simulated account for about 3 to 6 months before starting live trading. So after taking our courses, I would suggest to trade on simulated account for 3 to 6 months. And then after having enough experience, then you could start with live trading. And also you need the online platform SeasonAlgo. And this is what we are going to demonstrate now. And if you wanted to subscribe month by month, then it costs 56 US dollars. And for the European clients, it's plus VAT. And in case that you bought the annual subscription, then it's 33 US dollars per month. And in case that you took part in our full courses of commodity spread trading, then you would be entitled for a 10% discount on the SeasonAlgo platform. So let's now start with the SeasonAlgo platform. Just to summarize, before we will get to the real environment of the SeasonAlgo, here you have a link through which you can get to this platform. And this is a unique tool that enables statistic search for seasonal strategies where there is a high winning potential judged on historical trades. We are going to look at a real example of real trade. The exchange data, which is available in SeasonAlgo, can go up to 60 years back. And for most of the markets, SeasonAlgo has got the data for about at least 20 or 30 years back, which is perfectly sufficient for making all the analysis that we need. And this platform is applicable both for outright futures trades and for commodity spreads. It also enables to actively search for interesting trades by your own criteria. This is what we learn in our full courses. What are the criteria that we need for searching for the best spreads? And also it enables active filtering of selected spreads and very detailed analysis of them. Because the fact that we find the spread which worked perfectly over past 20 years doesn't mean that we want to enter this trade this year as well, because after analyzing the trade, we may decide that the development of the trade this year is not good and we don't want to trade it because it would be too risky. This is also what we learn in our courses, how to identify the spreads where the potential for profit is higher than with the others. Also, the SeasonAlgo allows for optimization of recommended trading window, and there are detailed backtests, and there is also a set of recommended strategies for each month. So in case you didn't know what to look for, what to search for, then there are some recommended strategies as well. And the SeasonAlgo also enables to check the intraday spread prices, and it also allows for setting the alerts. And even for unregistered clients, there is one free strategy each month. So let's have a look at the real environment of the SeasonAlgo. So this is the home page of the SeasonAlgo. And what is interesting, if you do not have any registration, you can go to this blog. It's in the main menu, and you can go down to free trading strategies. And in here, you can see one free strategy which is published for every month. So today we are the 29th of June. So in about 2 days' time, we can expect the strategy for July. So this is the strategy for June, which is the calendar spread of feeder cattle. And this is the trading window that the SeasonAlgo recommended. And this is the spread chart. And underneath, we can see a brief analysis of this chart. So the SeasonAlgo says that this spread was 87% successful in last 15 years. What does it mean? It means that on the history of last 15 years, 13 years were profitable and only 2 years resulted in a loss. Also, currently, the spread is moving at its historical lows. We are going to have a look in a minute what it means. And there is a strong seasonal pattern correlation in the seasonal window. This is what we can see here. We have the historical patterns, and they very strongly correlate within the trading window. But you can see that they very strongly correlate the whole time since the beginning of the spread. So you can see that. So this is again something what we really like. And there is a narrow legs spread with expected lower volatility. That means that the expiration months of the two legs are close to each other, which normally also means that there is a lower volatility. And there is a possible entry around support and a possibility to use a small stop loss. Here we have to mention that the SeasonAlgo prepares these strategies about 2 months before the beginning of the trading window. So when they say that there is a possible entry around support, so by that support they mean this kind of support. But at the beginning of the trading window, the market was already at different price levels. So it's very important to make a detailed analysis of all of these recommended strategies, because as I mentioned, they are usually prepared about 2 months before the beginning of the trading window. And in our courses of spread trading, which were now in mid of June, we made the analysis of this kind of spread, and we came to a conclusion that it wouldn't be very wise to enter this spread. And you can see that this is also what happened, because the market was going down. Now it's going up. But if we entered the trading position somewhere here, we would end up in a loss. So here, once more, it's very important to make a detailed analysis of spreads which are recommended by the SeasonAlgo. And here we can see the backtest. We can see that on last 5 years, there were 4 winning trades and 1 losing trade. And we can also see what is the risk reward, and also we can see what was the total profit. And these are the figures which are relevant for different historical periods. And underneath there is the absolute cumulative return chart, and here the blue line indicates that this is the return in last 15 years. The green line represents 10 years, and from the red line it's last 5 years. So this is how the market developed. And underneath, we can see the backtest, so how this kind of spread developed in particular years. So last year, for instance, there was a profit of $287.5 per contract. So this is what we can work with in case that we didn't subscribe for the SeasonAlgo use. However, in case that we logged in here, we would get to this kind of screen where we can define the spread. So here we can type the ticker of the spread, and we can define the trading window in here, and we can also define the historical patterns which we would like to display and analyze later on. But first of all, we would probably start with searching for a spread. We can either do it by going to the module strategies, and here we can see the section recommend. And in this section, we can choose July. We can click on OK, and the SeasonAlgo would find 34 records which are recommended by SeasonAlgo for the month of July. We can go back and we can see that these are outrights. You can see one leg, so this is the outright. Or we can see spreads which are composed of two legs, and in this case, we have also some so-called multi-leg spreads, which are spreads composed of more than two legs. But this is more advanced. This is what we have in advanced courses of commodity spread trading. So if we wanted to look for spreads that we are talking about today, then we could just filter the two-leg spreads, and we would get 18 records of the two-leg commodity spreads. And these are the spreads recommended by the SeasonAlgo for July. And here we have the beginning of the trading window and the end of the trading window, and all this kind of information that we would need to check very carefully. Because as I mentioned also here, in this case, these strategies were prepared by the SeasonAlgo about 2 months before the beginning of the seasonal window, of the trading window. Another possibility how to search for spreads is here in the search module. And here we can search by our own criteria. And here we can define the range when should be the beginning of the trading window. So the entry into the trading position should be between the 1st and the last of July. So we can see all these spreads in here in enter column. And we can search by our own criteria. We can also apply advanced filtering. This is all what we learn in our full courses. And we can search for spreads which have the highest potential for being traded this year. So let's have a look at the first one which we have here. I have already opened it in a separate window. And you can see that the SeasonAlgo recommends to trade this spread between the 13th of July, which we can see here, and the 9th of August. We can see that the historical patterns correlate very strongly, and also the current year spread correlates very strongly with these historical patterns. So it's quite likely that the current year spread is now going to go down, and then there is expected a strong seasonal move. For analyzing the spread, we can use this module Analyze, and we can go through different sections. Here, for instance, we can click on History, and we can see how these spreads developed in previous years. So this is how the last year developed. you can see that it worked very well. The seasonality really worked wonderfully. And we can have a look at previous years. So the year before here obviously was a fundamental, but then the seasonality worked perfectly during the seasonal window. Then this is the year before, where the seasonality worked up to a certain level and then it started falling. And this is the year before, and then the year 2010. So like this, we can have a look at all different years which are available in the SeasonAlgo database. We can also have a look at quotes, and here we can see, for instance, the volume of last trading days, and also we can see the first notice day and all the relevant information that we need for taking a decision whether we would like to trade the spread or not. The fact that the spread had wonderful historical results doesn't mean that it's going to develop the same way this year. So in our courses, we also teach how to decide whether we would like to trade the spread this year or not. Let me show you the spread of platinum gold. Let's have a look at the three strategies. And this was the strategy for December. Let me show you because it's a very good example. So this is the platinum gold spread, and you can see how wonderfully it developed and what was the correlation of the historical patterns. And over last 20 years, this spread was always profitable. Over last 20 years, it never resulted in a loss. And this is cumulative absolute return. And here we have the results of previous years. So in previous year, the profit was almost $3,500 per contract. And what happened this year was that here was the beginning of the trading window and it resulted in a loss. So even if the spread had the most perfect results in a history, it doesn't mean that it's going to develop the same way this year. And in order to be able to identify the risk, this is what we teach in our courses, how to find the most promising spreads and also how to avoid to trade the spreads which may not develop the same way like in the past, like in the previous years. So let's go back to the Analyze module. Here we have the continuation chart, and this is a monthly time frame. So here we have different calendar years and each bar represents a calendar month. So this can be used for identifying the support and resistance levels. Here we have the charts of the futures. So this is the long leg and this is the short leg. And here very useful is the chart where we have the spreads of last 20 years in the same chart. And here we can see that this year the spread is traded at very low price levels. So there is a high possibility that this spread will want to reach higher price levels. So this is also very important. So this kind of chart is very, very useful. Then here we have combinations of different legs. So the black one is our spread, but here the other ones are different combinations of different expiration months. Then we have a backtest of this particular spread, and we can see that over last 5 years it was 100% profitable. And on the history of 10 years, there was only one losing trade. And we can see, for instance, what was the average profit per year. Here is the risk reward. And here we have the backtest year by year. So we can see what was the loss in the losing year. And here we have a seasonal section, which is also very useful because here we can see that there is a strong correlation of historical patterns within the trading window. And here it's represented by numbers. So we can see the correlation between the historical patterns. It's very high, as you can see. And here is the correlation between the historical patterns within the whole duration of this spread. It's also very high. And here we have the correlation between the current year spread and the historical patterns. So the higher, the better, of course. And here we have the possibility to optimize the trading window. So in case that we were not happy or we had some doubts about the trading window that we found, then we can try to optimize the window and we can search for better results. So this is the way how to analyze the spreads. And once we decided that this is the spread that we would like to watch and to check whether there would really be a signal for entering the trading position, then we could save the spread in the portfolio. The portfolio is here, and we can save the spread in the watch list, which is the folder where we will watch for the opportunity to enter the trading position, or we can save it in a trade book in case that we already entered the trading position, or we can archive it, or we can put it in the temporary folder. So let's save it in the watch list. And now we can also save it here. And now we can go to the portfolio, to the watch list, and we can search for our spread, which is here. Let's filter it. So this is our spread in the watch list, and we can quickly check in this way all the spreads that we are about to trade. And if we wanted to enter information about the trade, then the SeasonAlgo will even keep the track of the development of our trade in here underneath the chart. And then if we recorded each of our trades, then the SeasonAlgo provides statistics of our trading results. So here we have open profit, closed profit, and total profit for all the charts which are stored in the trade book and watch list, and also for the archived spreads. And here we have the results for individual years. And for the particular year, we have also information about the quarters and also about the individual months. And if I clicked, for instance, on year 2014, then all the data will change and will display data for that particular year. And underneath, we have the portfolio, which is the portfolio of all the trades that we recorded in the SeasonAlgo platform. And another module which is here is the module Advanced Backtester. And this enables us to compare, for instance, two different strategies that we would like to trade, but our trading account would only allow us to trade one because we wouldn't have money for both. So let's say that we wanted to compare, let's say, this spread and this spread. We can compare it. And we can decide which one we would like to trade, because here it tells us that on the history of 5 years, this one was 80% profitable and this one was 100% profitable. This is on the history of 10 years and 15 years, how much was profit per one contract, etc. And also what was the risk reward. And here we can see the comparison of cumulative absolute return. This is on 5 years history. And underneath, we can see how this cumulative absolute return would look like on different historical periods. Another thing that we can use is that we will compare different types of profit target and stop loss settings, and we can see which kind of setting would provide better results. And we can do it in this way. This is from the Saturday course. We were comparing some settings here. So we can compare them in here. And we can choose the type of setting that would provide the best results. So again, we can compare all of these figures. How to work with that, this is again what we teach in our courses. And again, here you can see the cumulative absolute return of the different strategies with different settings. And here we can define different types of profit targets that we would like to apply, different types of stop losses that we would like to apply. And the SeasonAlgo will use the walk-forward analysis to calculate the performance of these settings. And the walk-forward analysis is usually used in algorithmic trading. It's not very common in commodity spread trading, but it's a very interesting feature, which of course is used by more advanced commodity spread traders. But if you were interested in this feature, then this is what we also teach in our courses, especially in the workshop of commodity spread trading. And the last module of SeasonAlgo is the module alerts. And here you can define different types of price alerts, like if you would like to enter the trading position when the market price reached a certain level, then you can define it here. And the SeasonAlgo will send you the email and will let you know that this situation happened. So you should go and have a look at your trading platform. Or SeasonAlgo can send you warnings when your open profit or loss in any of the charts that you saved in the portfolio or in the whole portfolio increased for a particular amount of money that you can define here. So it's also practical. Or it can send you date alerts, like for instance 2 days before the beginning of the trading window, the SeasonAlgo can send you the alert, so you would go back to your chart to check whether there was any signal for entering the trading position. So this is how we briefly went through the SeasonAlgo platform. And we are now going to go back to the presentation. So if you wanted to find out more about commodity spread trading, you can check the articles which are published on our portal or the videos which are there as well. And regarding the SeasonAlgo, actually we are the only company in the whole world which is providing training about how to work with the SeasonAlgo platform. And we are even authorized by the developers of the SeasonAlgo platform. When we made all these courses, we asked them to check the training program. They checked it, they approved it, and therefore this is the only authorized course worldwide